I'd like to lead off by having you answer one question before Harry and John, you begin to present on this topic. I'd like to know what's the frequency of which business owners come to you and they either don't have a buy-sell agreement in place or they do, and it's wholly inadequate for the business.
Harry or John?
Oh, hold on. I just had to unmute. So Nicola, it's a regular event. So we were contacted recently, actually Dave from somebody from Vistage, here up in Michigan. And a gentleman said, can you help me with his employment contract that he's going to be receiving? And he's going to be a shareholder in an S corporation. So this morning I received, before our call today, the proposed buy-sell agreement, and this will just get into the meat of things. We will read one line. The appraised value of the corporation, quote unquote, the appraised value shall be determined by the board of directors in its sole discretion, based on reliable approved financial statements, which means nothing. So this executive thinks he's coming in to an organization. They say they're going to give him the first 4% of the company. They haven't even talked about the taxes and what that means. And the fact of the matter is this paper isn't worth, it's not worth anything to the individual, because the board of directors could determine they want to fire him in a year or two, that the value of the company is zero. And this is the binding agreement that you have. So you have to be very, very careful about actually reading these agreements and actually working through examples. So that's just one of 100, that we see all the time, that people really don't pay attention to the detail. Nicole also, mentioned, you're doing this at the beginning of a relationship or somebody coming in, but remember, these things need to be looked at going down the road. And what I mean by that is companies kind of morph. You might be one company today, and then all of a sudden you've gone off in a little bit of a different direction. So the way you value the company could be different. So if you're like a SaaS-based company, you're gonna be based on revenue. But what if you weren't a SaaS-based company originally? You were just doing research and development, so it was more on the EBITDA formula. So those are the things that need to be addressed on an ongoing basis. And it's just like your will and trust and things of this nature. The one thing we're not going to talk today about is, because we have so many insurance experts, is when do you bring in insurance into your buy-sell agreements? And that would not only be life insurance, but it's also disability insurance. I have personally found disability is the hardest thing to deal with in buy-sell agreements. And when someone does become disabled because of a stroke or whatever the case may be, it's the most difficult for the business. So long-winded answer, Nicola, but that's just kind of the start of it. So John, can you pull up your PowerPoint?
Sure. I think I am allowed to share here.
You should be. I think I made you a co-host, so you should be.
All right.
Also, in those agreements, we should be defining what a disability is, right, Harry? If you don't
Absolutely.
define, like, you have to define like specific, like what specifically a disability is, because if Nicola, depending on what time of the day Nicola talks to me, I could be considered disabled if it's later on in the day, especially. So
just for the record, we have tried to have Harry declared incompetent a number of times, and it just hasn't worked.
That's not a joke, Dave. They wanted to be the arbiter of who decides whether I was competent to move forward. That is no joke. Obviously, that part didn't go very far.
So before we get into the PowerPoint, how have you seen partners agree on how to define whether or not someone is declared disabled? Like, what have you seen be what's a good measurement of that?
Yeah, some of it's going to be industry specific. In our industry would be, you'd have like a chargeable hour, or can you actually take care of your clients? There might be some indication like that. But if you had a SaaS company or a manufacturing company, it might be different, where you just say there are two doctors that have to say that you no longer can, continue on with your duties. But then the question becomes is that, are you replaceable, and should that automatically trigger a buyout, or can you still own part of your stock going forward? So you can actually handle it in several different ways. But Dave, your point's right on. You got to get all that baked into the agreement. because things happen. I mean, you know the story, I had a gentleman that I was working with, and a young kid dropped a donut and ran a red light and killed him. Now that's a little easier on death, but things do happen every day. People have strokes all the time. We have more early on dementia in our society. So these are things that are, they're front and center as you're dealing with the buy-sell agreements. And if people don't think this is true, it just happens all the time.
And
Yeah,
the
the one
best,
thing that I would add, I'm sorry, is just clearly what Harry brought up is that people will have a dual interest. You have an interest potentially as an employee as well as an owner. And those two sometimes need to be separated, other times they don't. If somebody's terminated for cause, you should have an automatic trigger of a buyout on the buy-sell, because if they're obviously being terminated for cause, you really want that person being your partner moving forward in the business.
Right.
yeah,
And
the
there's
other,
times, like Harry said, that, yeah, because of, say, a physical disability, they're no longer able to perform services as an employee, but that doesn't necessarily mean you got to cut them out as an owner of the business.
the other thing that I wanted you to address, and then Kyle has a question, and then we'll get to your PowerPoint, is, and I've seen this in firms that I'm working with currently, is that they put in a mandatory retirement age, right? And this is in a professional services firm. So they put in a mandatory retirement age, and there's a clause in there that says if this person is a partner, their shares will be purchased at, and a lot of professional firms have a set price for the shares, so they don't, to avoid the whole valuation issue, right? So the firm will buy out their shares at X dollars. But with medical care these days, no matter what you set that mandatory retirement age at, the people are still sharp. Even if you set it, at a relatively high level, some people will still be sharp at that relatively high level, and the firm will want to keep them. So the buy-sell agreement has to be adjusted accordingly. And that's just another reason, to your point, about sitting down and looking at these buy-sell agreements on an annual basis and making adjustments to them. There's a joke at one of the firms that I work with, and there are people on this call who will know this firm very, very well, is that the mandatory retirement age keeps getting adjusted every time one of the senior partners has a birthday. So, the triggering event, if it's a mandatory retirement age, I mean, there should be language in there that addresses that as well.
And James, to your point, the one thing you got to factor in now is, professions like our profession, all that's kind of changed with private equity coming in. So the question would be is, let's assume private equity comes in and you're a smaller firm and they're rolling up. So you sell out, let's say, in a 6 to 8 EBITDA range. Their ultimate goal is to sell at 12 to 15. So if you're a partner and you're out 3 or 4 years into the agreement, what price should you get? So there's a lot of maneuverability and a lot of play in that.
Yeah, for sure. All right, Kyle has a question. I want to take
Yeah.
Kyle's question, and then we'll turn it over to John. Kyle.
This was a comment more on the disability side. We've done this in the past. Use the actual policies, but just bare minimum, not even necessarily covering disability, like a true disability, but a smallest possible policy on all partners. And the triggering language is if the policy pays. So then you shifted all the liability for determining if they're disabled onto the shoulders of the insurance company. And it can be a $500 a month policy. Like, you're really just offloading the argument to the insurance company for a very small amount. Because that's the hardest one. That's the most nuanced for mental health and everything.
Yeah, that's interesting.
It's a good point, Kyle, 'cause I think a lot of times you might end up having a fight amongst the partners of, okay, am I really that disabled? And, like we said, we fought with Harry a number of times, and
Yeah. If you can get the insurance company to declare him disabled, then the rest of the contract becomes valid.
But Kyle, are you saying that you get the benefit of having the group insured rather than one person insured? And
you can do it.
Process?
If you can get large group, you can, if you have enough partners. Otherwise, you do individual policies. The whole purpose, like, some of the partners might want to have their income insured with disability. But in general, you want a policy on all of the partners even at the bare minimum, just so you have a consistent standard of this is the triggering event for a disability. So then like because the mental and depression one becomes the hardest one to quantify now. So if an insurance company will actually pay for that, well, then they've got a pretty damn good leg to stand on that they're actually disabled, because they're the last ones that want to pay. And you can get guaranteed issue too. Lenny pointed that out. Enough people, you can get guaranteed issue policies which help significantly.
All right. Okay, John, take it away.
All right, I think we're gonna let Harry kick off. You already did a heck of a job of introducing us, Dave, so I don't think we need that first slide to go through that. Harry, why don't you kick us off? Nicola kind of touched on this as well, but
This is, you know, Nicola really mentioned this, John. Let's just keep it going to the third one.
yep.
Okay, so understand on the form of the buy sells, there are different ways that people are bought out. There could be a redemption agreement where the actual entity is buying out the interest, which is different than the other partners buying it out through a cross purchase agreement as it's here. The difference for that can be substantial from a tax standpoint, and also could be, you know, with respect to who ends up owning the business. So if you had a redemption agreement, everyone's going to go up proportionately, you know, to that whatever is being redeemed. Where cross purchase, if other shareholders have the right to purchase, a person that was in a minority position, let's assume there were 4, you know, or 3% owners, and one leaves. If one can't afford to buy out the other interest, then you could be in a situation where somebody who was on equal grounds now actually owns 67% of the business. So you got to be very careful in how these things are worded and what can be done and things of this nature. Now, what we have seen in those cases sometimes is that there has to be unanimity in certain types of transactions or certain things being done at the firm in order to mitigate that. We have one new client we brought in last fall, very interesting. They can only sell to each other. However, if one wants to take the company to market and they can't get somebody to buy or agree upon a price, they have to liquidate what they merged 5 years ago, which makes no sense. You know, so you got to be really, really careful on how these things are worded and what can happen. And then there's obviously hybrid agreements where you can do a redemption and a cross purchase, you know, to give flexibility. Those get a little complicated. You probably want to have some insurance on that. John, you want to keep going?
Yeah, I just wanted to add one thing on the redemption agreement, only because it is a current issue. It's up to the Supreme Court. It was an estate tax issue of whether or not corporate-owned life insurance should be included in the value of the entity for purposes of estate tax valuation. So most of us would think it's not. It's the value of the operations of the business that you're being bought out at. The IRS was challenging that it should have included the value of the insurance that's going to be used for the redemption. So that has made it all the way up to the Supreme Court. We're just waiting for them to rule on that.
Yeah, and that's a big issue out there. I mean, how things are set up for the insurance, and all of the insurance experts here, you know, this call, I'm sure you're aware of that. But, you know, the other thing too, in all these transactions and valuations and everything else, remember the value of all this too, upon somebody's death, could impact their estate, because if they owned a certain part of, you know, of the company, they could actually get, you know, deferred taxes depending on the size of their estate, which we can get into in another presentation. So on the valuation, the stated price is probably not a great place to be for anyone. That's where you actually fix the price day one. It's just not going, you know, it's easy to apply, but it's not going to usually be reflective of actual value. If your company's growing at all, the market changes, you know, multiples change, and is listed here not appropriate for, you know, for tax purposes. So what's interesting here, just in the stated price, I'll get to something that's a little offline here, but when you have a closely held company, let's assume it's all owned by family members, and those family members could be brothers, sisters, sibling, whatever the case may be. And let's assume one of them passes and there's a redemption agreement. And that redemption agreement says you have to buy out at a certain price and let's just assume for whatever case that it may be, is they agree to a price on the redemption and you know, he gets paid. And at the same time, they want to issue stock to one of the corporate executives who's also a family member. That valuation has to be done at fair market value, which could be completely different than the value that was redeemed out to the other shareholder. So you got to watch it. You just can't take one agreement, one value, and use it for all purposes.
Yeah,
So,
especially if that exit wasn't related to death, because arguably that should have been at fair market value. But if somebody's just redeeming shares pursuant to a buy sell to a stated price or formula, that doesn't necessarily dictate what it should otherwise be issued at to somebody else as equity, because that is a fair market value. And you're otherwise dealing with valuation issues, compensation issues. Absolutely, those two are two independent transactions that need to be considered.
John, how have you dealt with this in your divorces and your marital divorces when somebody had a stated price?
Well, not surprisingly, the business owner always wants to argue that, you know, I've got to buy sell. I get bought out at $1 a share, and that should be the value for divorce purposes. Unfortunately, that doesn't usually hold the case. So a lot of it is going to depend on the standard of value in divorce based on the state that you live in. Illinois is a fair market value state. So regardless of what the buy sell says, because just like I stated there, not appropriate for transfer tax purposes, the IRS isn't bound by a buy sell agreement. They will acknowledge the buy sell if it's reflective or indicative of fair market value, but the IRS isn't bound by a buy sell generally, and divorce courts, family law courts clearly ignore buy sell agreements. That's not indicative. In Michigan, we don't have stated value, but for professional service firms, we call it holder's interest, which is pretty much investment value to the owner, which again, isn't necessarily going to be reflected in a buy sell agreement.
Wanna go next one, John?
Yeah.
Okay,
So in a formula-based valuation, that's where somebody just puts into the agreement that it's going to be 3 times EBITDA or 1 times revenue, something that seems very straightforward to apply. Like I said, it's easy to calculate, easy to communicate. People can understand it. Anybody can read it and apply it. But listed as a pro, but it's also a con, is that usually it reflects economic value at the time it's put into place. Given things have changed, Harry mentioned that markets have changed. You know, things that used to be 3 to 5 times EBITDA are now 10 to 12 times EBITDA, or whatever it is at the current time. Dave, I think you and Nicola had a post on LinkedIn not too long ago that says it's something that's got to be looked at on an annual basis. You just can't put these things on autopilot and just say, because I have a formula, it's going to move with the economy and it's going to move with the market. Not necessarily. You know, earnings may change, cash flow may change. That's going to impact the value, but the multiple of what willing buyers, willing sellers are willing to pay for it, that changes as well. And you just can't put one of these things on autopilot.
You want to go next?
And so the third, which is obviously the most accurate, but it's also the most expensive or time consuming, is to have a third-party valuation. Shameless plug, hire Cendrowski Corporate Advisors in order to do the valuation for you. You're going to ensure that things are going to be treated fairly at that point, because you will have a valuation that's going to reflect current economic values. The issue that you're going to come across, though, with hiring that third-party valuation of I've got a couple of things. It's just kind of this with differences. You know, Harry said the one, it's going to be determined by the board of directors. Well, obviously there might be bias that's included in there. Other times it'll say that each of the parties or the two shareholders are each going to get their own valuation. What happens if they're far apart? Sometimes they'll just say, we'll take the average of the two. I've seen others that have said, if they're within 20% of each other, then we'll take the average. Otherwise, the two independent valuators have to agree on a third, and they'll go out and do a third valuation. Things are starting to get expensive here if you have to pay, and who's going to pay for all these valuations? The corporation, the owner of the business. And I will tell you, I've been in this position. It's not so easy as the two of us coming up with that third party of who's going to be, because we're all going to lobby for something that's going to push for I'll say our professional opinion of what we think it's worth. So sometimes that third party, you could do baseball arbitration where that third party just says, I'm going to look at the two. I'm not going to do a third, but I'm going to say, which one do I otherwise think is most reliable?
Yeah.
But just because, again, you've got that third party, it's not the easiest thing to do.
So John, just one point where you were talking about is on the formula driven, and Sheldon will appreciate this, is if John came up with a 6% capitalization rate and I came up with a 7 or 7.5% capitalization rate, that could have a huge impact on the value of the underlying real estate. So what it would appear to be from the outside, just a 1% change, it's huge in the overall valuation. So you've got to be, careful. And that's what John was saying is people can differ within a certain range, but it can have a huge impact, whether it's for buy, sell, or for estate planning. Go on, John. I'm sorry.
Yeah, no, that's fine. And so, Harry had mentioned language is important, which is absolutely true. So from a drafting perspective, a plea to all the attorneys out there that are drafting buy-sell agreements, be very, very specific and cognizant of the language that you're using. So one of the very first things is everybody will throw out fair market value. Yes, we will determine the fair market value of the shares or of the units. From my perspective, fair market value is a term of art. It means something. That means willing buyer, willing seller. And if you're talking about a minority interest, then potentially subject to discounts for lack of control and lack of marketability. The common one that I see a lot is that the attorneys will say fair market value. By way of example, if the company is worth $20 million and it's a 10% interest that's being redeemed, then the value of the shares is $2 million. That's not fair market value. That's fair value, because it didn't consider that you have a minority interest that could potentially be subject to discounts. So be very, very certain. And if you have any questions, call a valuation person to determine what is it that we want to do. A lot of times I will get an agreement that may not even have a stated value, but it just says we're going to get an independent valuation. First question I ask the attorneys is, what standard of value do you want me to apply? And they'll say, oh, geez, I never thought of that. And what I end up doing is giving it to them both. Fair value without discounts, fair market value without discounts. Because obviously you're going to see that depending on what side you're on, they're going to have an interest in being the higher value or the lower value. I will leave it up to the attorneys then to fight that battle. That shouldn't be our battle as valuation people. So yeah, I'll give you all the information. You do what you want with it, but be careful with that. Specifying the valuation date.
John, on the fair market value, though, you and I both have seen agreements where it says fair market value, but there's no discount for minority discounts. So you still might do marketability for the company, but not a minority discount, right?
Well, but like that example that I gave where it says, for example, fair market value, company is worth $20 million, a 10% interest is $2 million. I'm not sure what they actually meant by that. So yes, depending on what discounts may be applicable, if your example ignores all discounts, did you mean that it ignores all discounts? Or Was it implicitly included in the value of $20 million that's already on a discounted basis? It's unclear. So that's why I'm saying be absolutely clear on what you mean and what, and if you want, because again, if you're doing this for a buyout purposes, not necessarily for estate tax purposes, then you could have whatever standard of value or whatever discounts you want applied for purposes of that agreement. You could say that we will consider a discount for lack of marketability, but not a discount for lack of control or vice versa. The fact that you got to buy sell almost would make it sound like you've got a built-in redemption agreement where a discount for lack of marketability then may be somewhat neutered if there's somebody ready, willing, and able to redeem those shares. But yes, you're absolutely correct in that you could consider one, none, but be clear of what you intend on doing. The valuation date, just clear. What do you mean? Is it the date of termination? The 30, the end of the month closest to it? Just be clear. And then on formula-based
Even on the
valuations.
valuation date, I've seen a lot of agreements. So let's assume you're in September and they'll say, if you do anything during, let's say 2024, the valuation date is the preceding year end. Let's assume it was December 31st, 2023. What do you do when there's a significant event in 2024 where the business went from one level to substantially higher during that time period? You just see a lot of litigation on that, or what have you seen?
Yeah, and it's something as the valuator, if that we see that, you've got to make the attorneys aware of that because that's going to become an issue. I don't want to be in a position where somebody says, well, why did you ignore that? And the idea is if you've got a certain valuation date, so our standards say we have to use everything that was known or knowable as of the valuation date. If it was not known or knowable, I can't include that in my valuation. So when somebody gives me a very specific valuation date, I need to be cognizant of that. But I also can't turn a blind eye and just let somebody, not let somebody know of certain things that have transpired since then that says, hey, I can't take this into consideration. But be aware that, say, there's been a huge uptick in this industry in the last 3 months that was not known or knowable, but you may be underpaying or overpaying for somebody's interest because of that. And then again, on formula-based valuations, be clear of what type or what level or source of financial information you're using for that. Is it a GAAP basis financial statement? That could present a problem because if the company doesn't otherwise prepare GAAP basis financials, now you're going to have to go out and have a restatement of those financials or a potential review or an audit to comply with that. If it's tax returns, Harry and I are working on one right now where those two are tied. Their internal financials are accrual basis, GAAP basis, but they file their tax returns on a cash basis. And there could be a substantial difference between those numbers. So be cognizant of that. Is it the last return or financial statement closest to the triggering event? Are you implying the trailing 12 months? So there's a lot of possibilities that can be considered, but be clear of what you're intending on using as part of that formula. And again, some language that I've seen that I've talked about that creates some ambiguity with respect to how it's going to be according. This was the without discounts is at fair market value or fair value. This was the second bullet. Always amazes me because I've seen judges do this as well. A valuation done in accordance with generally accepted accounting principles. There is no such thing. There is no valuation in accordance with generally accepted valuation principles. You may be talking about a fair value level of standard that's used for financial reporting purposes, but GAAP doesn't talk about what a valuation should look like. And then valuation shall include goodwill. something that I'm dealing with now on a couple cases, enterprise versus personal goodwill. Big issue on a buyout, a sale of a company, especially with a C Corp, it can be the issue of whether or not you've got double taxation versus one level of tax, and how you're going to deal with that, with potentially tying it with a non-compete agreement as well as a buy sell. So if you're not talking about death, but you're talking about a triggering of it, because of termination, Nicola mentioned that, how are you going to work going forward? The brother-sister agreement to that would be a non-compete agreement if you think that other person would be able to take business away from the existing business that's going to create a lowering of the value of the business. And then just, one of the things that I always like to talk about is the different standards of value. I know it sounds nerdy, but trust me, this is really, really important, and people need to be cognizant of it. So I've given you what those definitions are generally. So when we talk about a standard of value, we mean the value to whom. Fair market value is a hypothetical buyer, seller. Fair value is value to, generally, again, it could be for financial reporting purposes or under a dissenting shareholder or shareholder oppression case. It just means it's the value of the company unaffected by discounts. An investment value generally talks about that value at the very highest level, which is the value to a particular purchaser, unlike fair market value, which would be the value to a hypothetical purchaser. All three of those could produce a different value depending on how you apply it. So a lot of people like to say, why do people care why you're doing this? The value is the value is the value. It's always going to be the same. Absolutely not. IRS is always going to use fair market value. That's the standard of value for income tax purposes, estate tax, gift tax purposes. Fair value is generally a legal standard under state law that sometimes is going to ignore any sort of discounts that would apply. Investment value is what we're using when we're talking about exit planning for a business. It's trying to find the highest value for somebody, which is usually a sale to a strategic buyer, whether that be a competitor, a customer, somebody else out there. In certain instances, it could be a private equity firm that they're building a platform and it's their initial transaction that they want to get into it. So investment value and fair market value could be quite a wide distance between it, but you need to be careful and be certain of what you're otherwise trying to apply.
John, Harry, let me ask you a question along those lines. Have you seen a poorly drafted buy-sell agreement be a hindrance to the sale of a business?
Yes.
All right, explain. So this is an important concept for people to understand. So explain how like poor buy-sell agreements will hurt a business, the sale of a business down the road. And this is an important concept for the folks, particularly the professionals who are here, who are advising people to understand.
Yeah, because you can get into a shareholders agreement where somebody has the right of first refusal and maybe a right of first offer. So if that comes up, then one shareholder could actually be tying up, the company where the company really can't move forward, for one of the shareholders to sell or to actually sell the company, because they have their own, who gets to offer what. And, somebody could actually manipulate those provisions to buy out a partner at, let's say, the formula that John here was talking about, but they're planning to flip out the company to another seller at a much higher level. So those can be very, very difficult. The example I gave you earlier too, where two companies merged, one's a minority, one's a majority, they all have to do things in unanimity. But can you imagine trying to sell a company that if a sales process doesn't go through it to one's satisfaction, that they have to liquidate the company and separate it? I mean, somebody's gonna ask for that agreement to see it, because in many cases, you want the outside person to buy your stock in these companies for tax purposes to maximize capital gains tax and not ordinary income tax. You want to be selling the assets. So that actually come into play. If they see that, they're going to know they have a lot of negotiating room with respect to the potential purchase price. So I think it's there all the time. But John, why don't you?
Yeah, and I'll put the flip on it that says, if you've got a stated redemption price or a formula at a time that is greater than what the market is, you've got somebody that's gonna, if they're looking at this, buying this company, says, geez, I gotta redeem, if somebody wants out, I gotta pay them more than what I'm willing to pay for the company. That becomes a problem. So somehow you need to address, or they're gonna be looking at that. It should be part of the due diligence on the acquisition, is inquiring, what kind of shareholder agreements do you have out there currently, and what are those provisions? Because yeah, it may cause a detriment, or somebody that says, well, hell no, if someone has the ability to redeem their shares at that high of a price, and get stuck with that obligation, I don't want to assume that obligation, or I don't want that potential based on that given price. It's a problem.
Yeah. No, it's an important point. One more question along these lines, and I've seen this again in professional firms. So you want to carve out, the firm grows at a rapid pace. You want to carve out 10% of the ownership of the firm to sell to a handful of up and coming people, right? And you're going to allocate that, that portion based on whatever you decide is going to be that, whatever formula you're going to use. So, you get 2% of that 10% and it vests over this amount of time. How should that be addressed in a buy-sell agreement?
Go on, John.
From a valuation perspective, Dave, usually we would look at fully diluted shares. So assuming that 10% has already been allocated, just so somebody's not getting a benefit or a detriment because of the issuance of that. So typically, yes, we would look at, especially if there's even any options outstanding with respect to the stock. Again, looking at the fully diluted shares on that they may not be in the money at that point. They may be in the money, but not 100% vested. But we'd otherwise want to take a look at that to consider all possible transactions to make sure that somebody is getting the true fair market value. Because on a sale of the company, yes, they're going to also be looking at that, which sometimes these types of allocations, whether it's be stock or options, get triggered on a triggering event as well. So that otherwise needs to be considered.
Okay, thank you.
John, you want to just flip through the next couple slides so we're going to have a limited time?
Yeah, just again, where we are today when we're talking about selling or with respect to valuing a particular interest in a company, not 100% of the company. If we're talking about 100% of the company, we're talking about the traditional control value versus what we're now calling strategic control value. So strategic control value is that investment value to that one buyer that's willing to pay the highest dollar amount because there's some sort of premium there. They have something that the company wants, as compared to a financial control value, which is John, Dave, Nicola, anybody else, Harry, looking at saying, this looks like a good investment. It generates cash flow. I want to invest in that company. Once you get past that, now you're talking about the interest in the company, which is a marketable minority. So that one's going to have a discount for lack of control. That says you can't control it, but it's still a freely marketable interest. Public market type values. Well, most privately held companies don't trade at that. You can't pick up the phone, call your broker and say, hey, sell my stock in, XYZ tool and die company and get me my cash. So therefore, hypothetical buyers are going to take into consideration this marketability discount that says, when am I going to receive the value of whatever it is that I'm buying? And obviously there's a lot of things that impact it. If you're considering, or if you're interested in the things that are considered, there's a case that we use now called Mandelbaum. It was an estate tax case. And Judge Laro identified what we call the Mandelbaum factors that says these are the things that we look at to determine how marketable an interest is. So, what industry, your financial statement analysis. Is there a redemption agreement in place? Do you make distributions on a regular basis? There's 7, 9 factors that the tax court identified, but they all come into play in determining what level of marketability discounts should apply.
Next one, John.
Yep, that's
Question.
basically the end of it. I know we had a couple comments and questions.
Yeah, John, before let me do Susan's comment first, and I'll ask Nicola to weigh in on this. So,
You know I can't help it.
absolutely.
You know I
Some
can't
about to
help
listen
myself.
to a webinar when we're done on this.
So we've covered we touched on the FTC decision in Chicago, and we didn't do it in New York. I think we did it in Chicago and Miami. So Nicola, why don't you read Susan's question and then touch on that and pitch it to the guys if you need to afterwards.
I would love to. Susan asks, do you see the new FTC non-compete rules having any impact on buyout agreements? So let me start with this. So the FTC rule banning non-competes is actually not effective just yet. So it will be effective, we're targeting in September, unless it is the actual enforcement of the rule becomes stayed by the current lawsuits that are going through the court system. They've asked for an injunction. If that injunction is granted, it could actually stay enforcement. So we are waiting to see when it will be effective. So right now, the rule's not in place. And to answer that specific question, if the rule as it is written becomes the law, then that rule actually has a carve out for the sale of a business non-competes. So what that means is if you are selling your ownership interest in a business or substantially all of the business's operating assets, then you are entitled to have a non-compete in place with respect to that business owner. So the FTC has said we are going to bless that, and that's actually in line with where the case law has fallen for decades, which is that you are entitled to extra protection when you are dealing with a sale of a business. Why? Because it is the goodwill of that business. It is everything that has been put into it, so the law will better protect that when we're talking about non-competes. So with that, I am interested to hear, John, Harry, your thoughts on, outside of that specific exception, where you see that new rule having an impact on these agreements.
Yeah, I'll just weigh in quickly on the valuation side, Nicola, which is we have always looked at non-competes as a way of or being indicative of personal goodwill. Rather than enterprise goodwill. If it's enterprise goodwill, it belongs to the business and it transfers with the business. So if you're buying out somebody's interest in the buy-sell, what you're going to be concerned with is whether or not there's any personal goodwill that can otherwise, you need to, I don't want to say block, that makes it sound like you're doing something illegal, but protecting the business interest that says, yes, we understand you have certain relationships, you have certain knowledge that you could otherwise take that's going to harm the business. We want to make sure that that's going to be protected. So along with that buy-sell or on a sale of a business, if you see that there's a non-compete attached to it, that's indicative that somebody believes that there's some element of personal goodwill that creates some income tax planning opportunities, because again, you could structure it as a sale of two interests. One, sale of your personal goodwill, which would be capital gain, versus a sale of whatever at the business of enterprise goodwill. If you're dealing with a C Corp, now you got 2 levels of taxation there. Non-compete agreements, sometimes, we'll have a tie-up provision or a compensation agreement where it's ordinary income, but that's all sorts of tax planning. But yes, if I see that there's a non-compete in a transaction then yes, that tells me that there's personal goodwill. People that aren't worried about the departing owners competing with them don't usually enter into non-compete agreements because there's nothing that they otherwise have to pay to protect.
Yeah, Nicole, I would just say that I think it kind of further drives home that if a company has trade secrets or processes, all their IP, make sure that's protected. So if that person does leave with a non-compete, they can't utilize that information. We've had a number of cases where people just get up and open up a new company next door. You know, they not only stole the data, but they're stealing the IP, the process, and you know, trade secrets, you have to document a certain way. So I would say that, you know, it's gonna force companies to really look at their IP differently if this new rule does come into place. Because that's usually what your company has, right? It's the IP about how you do things, how you process them, and how you approach them. So I think it could have much broader implications, and I would just say to all the professionals here, you should be talking to your clients about how to protect all that now. So I mean, who the hell knows how this case is gonna come out?
Yeah, the one thing I would ask Nicola is, because I heard somebody mentioning it, that there is a difference, and I don't know if they're treated differently under the FTC rule, is a non-compete versus a non-solicitation provision.
Oh boy, here we
Yes, yes. So I'll give you the short answer. You're right, John. They are, non-solicitation clauses are going to survive the rule. So they are not impacted by that rule so long as they do not function as a non-compete. Meaning if you write them so broad that essentially you're locking someone out from going to another company and still performing the same job, then that's going to be considered a non-solicit. So generally speaking, they survive. They are going to be treated different.
Gotcha, thank you.
And
But
what
the
if you
big
have them-
carve out. I'm sorry, Harry, go ahead.
But I was gonna say, Nicola, what if you have them based that if you do certain things, that you just then owe the company X% of that business, rather than saying it's not a non-compete? So it's a, you know, somebody leaves, they take part of the business, and then they have to pay you X%.
There's a financial penalty, yes, for
There's a
them.
financial penalty on it, but you're allowing them to compete.
Yeah, I mean, in the way you are describing it, I don't see that being a problem. So it really comes down to like exactly how is that written and what is it actually doing? So not just, you know, it's the function over the form here. It's like, you know, what is it actually intended to do and what will it end up doing?
Right, but you can, I get to kind of the same place, not exact,
Mhm.
by putting in those type of provisions.
I want to highlight what you said at the beginning there, Nicola, too, in that this is one of the things that whatever you think of this ruling and however it proceeds, this is one of the areas you said that is carved out where it absolutely does apply when you go to sell a business, correct?
Correct. It's the one area where the FTC has clearly blessed it and said this is going to be an exception.
You know, and I spell that out because as I'm sure none of you would be shocked to hear, somebody who does this sort of thing for a living was like, oh, there was just a thing the FTC said non-competes. And I'm like, nope, talk to Nicola. Completely applicable here. So, you know, misinformation, bad information is way, way worse than no information at all. So, you know, and we could go on and on about where you're getting your facts from, but always check with the experts before opining on something like this, because there's things, you know, this and the Corporate Transparency Act are two things in the last 6 months that have been blatantly bastardized and misquoted over and over again. And I'm as guilty as anybody else. Bill Byers and I had a conversation about this last week. So make sure you check with the experts before opining on any of this. Other questions before we let John and Harry off of the hot seat? Okay, Nicola, to you.
Okay, I just want to say thank you. That was very informative, Harry and John. Really appreciate it. If I could just highlight two things that in particular to just really allow that to stick with you, it's make sure that you're really focused on the details. I mean, how much have we heard here today that the details really matter, what you are putting into that agreement? The more you think through it and the more detail you spell out in the agreement, the less you leave to chance or determination by whatever the default laws are in the jurisdiction where that agreement is going to be operative. So if you don't spell something out, how the valuation is going to occur, or what happens in the event that, you know, one partner is no longer part of that business, or if something happens and changes in the business that you didn't account for it, you default to state law. So that may not be what the partners contemplated at the time that they entered into this business. It could be completely different. And you're stuck with that if it's not spelled out in the agreement. And the other thing I would highlight again is just making sure that's an organic document, that it is living and breathing. And as that business changes and shapes into something different over time, it should be addressed in the agreement itself. So definitely make sure you're working with your, not only your attorneys, but valuation experts, your accountants, those where that agreement touches on a lot of different areas, as we heard, insurance as well. So you really ask those questions to the professionals that have the answers to those as you're putting them together. So you have a really tight agreement that makes sure that everything's taken care of in the end and there's a plan in place. Thank you both again. Really appreciate it. And at this point, I will turn it over to Dave because we've got an interview coming up with Sherry Jemay.